If you were born before 1961, the IRS has already changed 5 rules that directly affect how much of your Social Security check you actually get to keep. And the reason most seniors have never heard about any of them is that the IRS does not send warning letters when it makes changes that cost you money. It only sends letters when you owe them something. Before I walk you through all 5 rules, I want you to understand the size of what we are talking about. The average senior born before 1961 loses between $3,400 and $6,800 every single year because of these 5 rules combined. Not because they did anything wrong, not because they missed a payment, not because they cheated on their taxes, because the rules changed and nobody explained what that means for someone in their specific situation. Between $3,400 and $6,800. Let me say that again, per year, gone. By the end of this video, you will know exactly which of these 5 rules is taking the most from your check and what you can do about it this week. Now, I also want to tell you about a woman named Linda, because Linda is the reason I made this video. If this is your first time here, hit subscribe. I put out new videos every week on exactly these kinds of issues. Rules that affect your retirement income that nobody talks about clearly. And I want to hear from you today. Drop a comment below. Were you born before 1961? Yes or no? I read every single one. Linda. Linda is 64 years old. She turns 65 this October. She spent 31 years as a school nurse in Ohio, and she paid into Social Security every single paycheck. She has never been late on a bill in her life. She clips coupons, she watches her spending, she has been checking her Social Security statement for 2 years, planning the exact month she is going to file. What Linda does not know, and what nobody has told her, is that 3 of the 5 rules I'm about to show you will apply to her the same month she turns 65, and 2 of them will follow her for the rest of her life. Let me show you what Linda is walking into, and more importantly, how she can walk out of it. 5 IRS rules. Rule 1, and this is the one that surprises most people. You paid taxes your entire working life. You paid into Social Security every single paycheck. So when you start collecting, that money is yours, right? Not according to the IRS. The IRS can tax up to 85% of your Social Security benefit as ordinary income. 85%. Here is what that means for Linda. Linda's estimated Social Security benefit is $1,900 a month. That is $22,800 a year. The IRS can tax up to $19,380 of that at her 22% bracket. That is $4,263 going back to the government every year from money she already paid taxes on to earn. What Linda can do about it? Roth conversion before she files. Shifting income to a Roth before 65 can reduce her combined income and drop her below the taxation threshold. Rule 2, the Medicare IRMAA surcharge. Rule number 2, and this one has a 2-year delay that almost nobody knows about. When Linda files for Medicare at 65, the government does not look at what she earned this year to decide how much her premiums will be. It looks at what she earned 2 years ago. This is called IRMAA, Income-Related Monthly Adjustment Amount. In plain English, if your income was over $97,000 2 years before you apply, you pay more, significantly more. Linda took a large IRA withdrawal 2 years ago to pay off her car. It pushed her income over the threshold just barely. She does not know that this October, her Medicare Part B premium will be $244 a month, not the standard $174.50. $244 every month because of one withdrawal. That is $8,340 extra over 5 years. What Linda can do? File a life-changing event appeal with Medicare, Form SSA 44. If her income has dropped since that withdrawal, she can appeal and get the standard premium immediately. Rule 3. The RMD clock starts at 73. Rule number 3. And this one does not start until Linda turns 73. But if she does not plan for it right now at 64, the damage is already being set in motion. Required minimum distributions. The IRS forces you to take a percentage of your traditional IRA and 401k every year, starting at age 73. You do not get to choose. You do not get to skip a year. If you miss it, the penalty is 25% of what you should have taken. Linda has $240,000 in her traditional IRA. At 73, her RMD will be approximately $9,500 in year one. That income stacks on top of her Social Security. It pushes her into a higher SS taxation bracket. Rule 1 and Rule 3 work together against her at 73. What Linda can do now? Roth conversions between 65 and 73. Every dollar she moves out of her traditional IRA now is a dollar that will not be forced out at 73 at a higher tax cost. Quick question before we go further. Do you have money in a traditional IRA or 401k right now? Type yes or no in the comments. I want to know how many of you are in the same position as Linda. Rule 4. The widow tax penalty. Rule number 4, and this is the one that nobody warns you about until it is too late. Linda is single now. Her husband passed 4 years ago. The year he died, her tax situation changed completely. She went from married filing jointly to single in a single tax year. What most people do not realize is that the standard deduction drops. The tax brackets compress, meaning the same income hits higher percentages faster. And for seniors receiving Social Security, the combined income threshold that triggers SS taxation drops from $32,000 to $25,000, $7,000 less runway. For Linda, this single filing status cost her approximately $2,100 more in federal taxes in the first full year after her husband's death. Nobody told her. Her previous tax preparer did not catch it. The IRS certainly did not call. What Linda can do: request a widow's income recalculation review with a qualified tax professional and look at whether a qualified widow filing status applies for up to 2 years after her husband's death. Rule number 5, and this one specifically targets people born between 1954 and 1960. If you were born in that window, your full retirement age is 66 and some months. Not 65, not 66 flat. If you file for Social Security before reaching your full retirement age, and you are still working or have earned income, the IRS will take back $1 of your benefit for every $2 you earn above $22,320. Linda is still doing 12 hours of substitute nursing a week. She earns about $16,000 a year from that. She planned to file at 65 to start the checks coming in. But because she is still earning and has not hit her FRA, she will have benefits withheld until she stops working or reaches full retirement age. What Linda should do: delay filing until her full retirement age, or stop the part-time work first. Filing at exactly the wrong time costs her the most. The total. Let me add up what these 5 rules mean for Linda. Rule 1. SS taxation at 85%, $4,263 per year. Rule 2. IRMAA Medicare surcharge, $828 extra per year. Rule 3. RMD tax stacking at 73, $1,900 per year. Rule 4. Widow single filing tax increase, $2,100 per year. Rule 5, earnings test benefit withholding, $1,400 in year 1. Total, $10,491 per year. Let me say that again. $10,491 every single year from a woman who did everything right. That is not an error. That is not a penalty for doing something wrong. That is what the rules do when you do not know they exist. Now, here is what Linda is going to do this week, and here is what you should do too. Step 1. Pull your last 2 years of tax returns. Look at your combined income. That is your adjusted gross income plus half of your Social Security plus tax-exempt interest. If that number was over $25,000 as a single filer or over $32,000 as a married filer, Rule 1 affects you now. Step 2. Check your Medicare application status. If you had a high income year in 2023 or 2024 and your income has since dropped, file Form SSA 44 immediately. You can appeal the IRMAA surcharge. Most people never do. Step 3. If you are between 65 and 72 right now, this is your Roth conversion window. Every dollar you move to a Roth this year is a dollar that will not be forced out as a taxable RMD at 73. Step 4. If you lost a spouse in the last 2 years, ask your tax preparer specifically about the qualified widow status and whether your first-year filing should be reviewed. This is not automatic. You have to ask. Step 5. Before you file for Social Security, look up your specific full retirement age using your birth year. If you are still earning income and you are under your FRA, do the math before you file. The earnings test is real. 5 steps. This week. Not next month, not when you get around to it. This week. As for Linda, she is going to delay filing until her FRA, start her Roth conversion this tax year, and file Form SSA 44 to appeal her IRMAA surcharge. 3 moves, 3 weeks, she keeps the money. You can do the same thing. Before you go, I have one question for you. Which of these 5 rules surprised you the most? Drop the number in the comments, 1 through 5. I want to know which one nobody warned you about. If this video helped you, please hit the like button. It takes 1 second and it helps more seniors find this information. And if you're not subscribed yet, hit subscribe right now because the video I'm releasing next week covers what happens to your taxes the year after your spouse dies. That one will change some plans. I'm Clara Morgan. Thank you for watching. Protect your retirement. You earned it.